Hi, I'm Isabella Bizone with Fixed Income in Focus. Today, I'm pleased to have with me Meredith Shaw from Morgan Stanley. Meredith, it was great seeing you back at Fixed Income Leaders Summit in Boston, and thank you for joining us today.
Likewise, thanks, Isabella.
So, Meredith, bond ETFs were created to provide easier access to fixed income markets. And over the last few years, they've helped facilitate liquidity in the bond market. So how have ETFs impacted bond pricing and liquidity?
So there's a few key elements of the ETF that I want to highlight that explain how they're additive from a liquidity perspective. So the first point is the create redeem mechanism, which allows for primary transactions. It's the hub of the wheel, and it allows for us to efficiently transfer risk. The second element of this is the price discovery vehicle, and the price discovery vehicle has led to the development of algos. The other thing to think about is that the growth of algo trading, the growth of portfolio trading, the ETFs are the hedge for that. So as we think about credit market structure, all three of these things will grow together. So if we look back over the last 5 years, there's been some pretty prominent shifts within the credit markets. The first is PT, portfolio trading. ETFs and ETF options are the fastest growing segments within credit markets. The other piece that really stands out to me is portfolio trading as a percentage of cash bond markets is now about 8 to 9%. Just 5 years ago in 2020, that number was closer to 2%. If we look at ETFs from the same prism, ETFs are now, from an IG perspective, 15% of cash bond volumes. That number is up from 7% in 2020. And high yield ETFs have also shown similar growth. They're now accounting for roughly 30% of volumes. That number used to be about 20%.
So let's fast forward to today. There's been a lot of innovation in this space. How have innovations such as thematic or actively managed options altered trading strategies, and what do you see as the associated risks and rewards?
That's a great question and very topical. If I put on my ETF hat, I really think about the product evolution in ETFs in chapters. So the first chapter, there was a lot of index beta products that were offered to the market. The second chapter was more of a smart beta factor-based. And then this third element is the actively managed and derivative products. If we look at fund flows year to date, of the $9 trillion in ETF AUM, roughly 10% of that is in active strategies. But if we look at the year-to-date inflows, that number is 30%. So the inflows into these active strategies is really outpunching its weight class. And from an investor standpoint, and I'm thinking about this more from an asset allocation perspective and a model perspective, it gives investors more tools and more building blocks. There's more variety as they think about their asset allocation strategies. And rather than just pure beta plays, there's a lot more optionality in their toolkit.
So I'm glad you brought that up. How do you see the growth of active versus passive ETFs shaping the competitive landscape? And what factors do you see driving preferences for one or the other?
It's democratizing investing, particularly in fixed income. So the harder to reach parts of the market are now easier because of the ETF wrapper. You have CLOs, you have active ag products, you also have even private credit. And so that's one element of it. The other important element of this is what's happening within asset management. So within asset management, traditionally, you had a few big ETF issuers. There were a handful of firms that focused on this particular wrapper. And what we're seeing now is that a lot of different asset managers who are huge asset managers in their own right are starting to deviate. They want to offer their investors options. So it's not just a mutual fund strategy, it's ETFs, it's SMAs. And I think what they're doing with their strategy, they are looking internally, they're looking to see what they already do well, and they're trying to leverage that. So that very process is really driving the growth in active. And one specific example around this, and one trend we've noticed, is this idea of taking a household PM that might be very well known for their active strategies. They have great track records. They're starting to take these names, and I call it the all-star PM power because everybody knows these names, and they're putting them on their ETF products to help sell them and leverage the strength of the internal organization. And so I think that in addition to giving more investors optionality, it's also what's happening within asset management that's driving a lot of this.
I know we touched on electronification a little bit. How do you see the push toward electronic trading impacting your desk's workflow and how they're sourcing liquidity in today's market?
Many years ago, or a few years ago, the way we organized our traders was it was very sector focused, line-based. People kind of operated in their own little world. We have moved now to have a more centralized model. And the way we look at our index products is that we have our portfolio trading, our ETF create redeem, our ETF secondary, as well as our bond algo trading, that risk lives in one place. So that's a pretty, it's a departure from how it's always been done in credit. That's the state of play right now. If we look forward, where are we going? I think the trend that we're seeing is cross asset. So it's not just within credit, but investors and clients want to be able to think about risk more holistically, and that's the direction of travel. I think it's exciting because there's more outlets for risk, more outlets for liquidity. But the challenge of that is going to be evolving the infrastructure of a bank from a tech perspective and how we've always thought about our risk books.
It's really interesting. So speaking of looking forward, as we're seeing more conversions from mutual funds to ETFs, how do you see preferences for both of these vehicles evolving in the future?
Asset managers want to give investors lots of options and lots of tooling, but you hit on a key point as we think about mutual fund conversions. I think according to the Bloomberg numbers that I just pulled, since 2021, nearly 120 billion in assets have been converted from the mutual fund wrapper into ETFs. There's also been a focus on the growth of fixed income relative to the equity markets. So if we look at the 2 trillion in fixed income ETF AUM globally, what I find interesting is that it took 20 years to reach 1 trillion, but only 4 years to hit that $2 trillion mark. So the growth is there. Interestingly enough, I also looked just this morning, we have now collected year to date within the US almost 210 billion in inflows into fixed income ETFs. That has surpassed the high water marks of the previous years, which was roughly around 200 billion. We still have 3 months to go. So the growth is there, but what I find really interesting is that even in light of all that growth, if we compare the fixed income ETF universe relative to equities, the percentage of investable assets in fixed income, only 2% sit in that ETF wrapper. If we compare that to equities, that number is closer to 8%. Despite all the growth, there's still significant more growth to go.
Interesting indeed. I look forward to seeing this growth evolve. Thank you so much for sharing
Of course.
your insights today, Meredith.
Thank you for the time.